Monday, May 13th, 2024, Maneco 64, home of alternative economics and contrarian views. I've told you many times that once gold and silver start shining a little bit, there will be a lot of people, especially in the mainstream media, who are going to come out and denigrate gold. And we're starting to see that. This is, of course, from 2004, when gold just started breaking out above 400. Recently, there's an article on Market Watch by Mark Holbert saying gold is overvalued now and won't help you beat inflation in coming years. And I'm going to make a few comments about this article, but I try to read your questions as much as possible. And recently I got this comment, not a question, on the comment section. And Leo Cloyd 1 said, if you stored your wealth in gold in the 1970s, congratulations, you broke even just a few months ago. Adjusted to inflation, you made a loss. And I assume, of course, by inflation, he means the CPI. So far to gold being a store of value. So that's what we're going to look at today. And the lesson, I think, to learn from the numbers we're going to look at is that if you do buy gold and silver or stack, physical, of course, you need to do it as regularly as possible, which is the so-called dollar cost average, right? And you'll see why in a minute. A couple of announcements before we go further. First, I wanted to thank you for all your support for the channel. We've gotten over 100,000 subscribers. That's not my objective here on this channel, the number of subscribers I have, but it helps. So if you haven't subscribed yet, make sure you do. And the other announcement is to do with my affiliates. Yes, if you have been regularly buying silver and gold, and you like to keep it safe, have a look at the Dirty Men's Safe. It could be a good way to hide some of your, not just gold and silver, but your valuables, documents, and things like that. I have a promo code. You can get 10% off. All the details are below in the description of this video. And as for my precious metals affiliates, Miles Franklin still has the same special from last week. So if you want to contact them, let them know that Mario or Maneco 64 sent you there. You can email info@milesfranklin.com, or you can call them on a toll-free number 1-800-822-8080 for my UK viewers. Gold investments. They always have specials, and I think the specials are below in the description. So back to the 1970s. And the 1970s, gold started the decade, at least until August 15th, 1971. Gold was trading at $35 an ounce. Yes, it might have gone up a little bit in the international market, and that's one of the reasons why not Kennedy, but Nixon had to close the gold window. So what I wanted to do, because of that comment from that viewer, is look at the average price of gold from 1970 to 1979, because that's the 1970s. I think a lot of people, what they do, they look at January 1980, right, when gold topped around 887, and they take that number and they adjust it for CPI, what they call inflation. And why do I do that? Well, because inflation is not the CPI. The CPI is the rise in prices of that consumer basket of goods, right? But let's keep it simple. Let's keep it colloquial and say that CPI is inflation. So And they point to the fact that that high in 1980 has just been achieved in gold in terms of the CPI, and that's why it's like everyone in the 1970s bought their gold in January 1980, which makes no sense, right? I've been fortunately stacking a bit of gold and silver since 2002. And of course, I don't have the perfect annual average in terms of price, but I think that's almost impossible to do unless you're very wealthy and have a lot of cash. You can buy a little bit of gold every day, for example. At the same time, you can space it every day, or maybe at the end of every month you could do that, and I think that's the best way to do it. So just before we look at these averages and the numbers, just wanted to talk a bit again about this Market Watch article, because it has a paywall, but Clive got into it, and he got a video that the fund manager who's saying that gold is going to underperform, his name is Claude Herb. I think he's a commodity fund manager. Back in 2018, he did this interview, and I listened to some of it. And he said that gold was outperforming CPI, and at the time it was at $1,300. And he said the real, gold according to the CPI should be at 880. So you should short gold because it's going to drop back to 880. So how did it come up to 2,400? I mean, I hope he didn't get his clients to short gold. Well, because he's looking at and trusting the government CPI. And if you look at Shadow Stats, John Williams' Shadow Stats, he has alternate inflation charts, the CPI charts. So if you look at this chart here, the alternate CPI, which is based on the 1980 government calculation. If you go back to like the early 2000s, it's been just above 10% and below 10%. Yes, there was a year, I think 2009, where it dropped to 6, but it's been mostly between like 7 and even 12. And I've pointed to this many times. In Gold We Trust, they keep a scorecard of gold. And since the year 2000, gold has performed in dollars at a rate of 9.3% increase per annum. So that kind of fits in with the way the government used to calculate CPI. And I think this guy, Claude Herb, he believes in the red number, right? Where the government totally manipulates CPI. And that's why I think he got it wrong. So enough of that, and let's go to the averages, historic averages of gold. I'm going to put a link to this, and you can play around with it. So there you go, historical gold prices, 1833. It says to present, but is 2016. But we're only looking at the 1970s, right? So as you see here, 1970, the average price was 36.02. You can see that in the 60s, it was pretty much steady at 35. And it was only in 68 that it started picking up. And then 1971, it rose to 40. And then after Nixon closed the gold window, and he didn't, and governments couldn't redeem, foreign governments couldn't redeem their dollars for gold, well, gold went floating. And as you can see, the price rose steadily from 36 all the way to an average of 306 by 1979. So I added up all those numbers, divided it by 10, and I got a price of 131.92. So that was the average price of gold in the 1970s. So that comment there was basically assuming that everyone bought gold at 887 in the 70s, which is complete nonsense. And even in 1980, the average price was 615. So next, I brought up the inflation calculator from the Federal Reserve Bank of Minneapolis. And for example, if you put the average price of gold in 1980, which includes, all the months traded in 1980, the average is 615. And by the end of last year, it would have meant a price of 2,273. And gold was below that level at the close last year. I think the close last year was 2,062. So if you had bought all your gold in 1980 at an average, let's say, of 615, you'd still not be breaking even. I agree with that. But the 1970s, that's a different story. So if you replace that 615 with 131.92, you get $487.77 by the end of last year. And I know that I'm not sure if this calculator has taken into account all the gimmicks they've done with the CPI, but be as it may, so gold last year should have been at 487.77 if it was going to cover the cost of someone who bought gold in the 70s at an average price of the 1970s. And I know that that's virtually impossible to do, but if anything, it says that gold has outperformed on average in the 70s, up calculating at 2023 prices, has outperformed more than 4 times. So that's the moral and the lesson of the story, or the 2 lessons of this story. First is that you need to try to not just buy when gold is going up. You need to buy it whenever you can, or exchange fiat currency, which eventually goes to worthlessness, into money whenever you can. And the other thing as well, beware of not just people like this guy who commented and just used one number and said, made a generalization, but beware of the mainstream media, because they'll do the same kind of thing. And I would speculate that the person who commented on my video there is probably been watching a lot of mainstream media, and that's how they denigrate gold, because they don't want you to get out of the system and to have real physical money that makes you a little more self-sufficient and independent from the powers that be. So with that, let's quickly look at where the markets are then this morning. It's 8:15 a.m. London time. This week, the big number is going to be the CPI. I think is coming out on Wednesday. It's supposed to drop a little bit on an annual basis. We'll have to see what happens. But I've noticed that M2 is starting to pick up quite a bit. Well, a little bit. I mean, it's stopped dropping, as you can see here. And for March, it's picked up quite a bit. It's at 20,841. It's up 149 billion from the low. So I think this is significant, because if the Fed's going to start not unwinding, but they're going to be decelerating their quantitative tightening, and they might even cut this year once or twice. So I expect this to be pointing to higher. This is inflation, the growth of M2, but I expect this to result in CPI that's going to remain very sticky. So where are we now then? Well, gold is down a little bit. It's down $10 at 23.50. High's been 65. The low's been 47. Silver is virtually unchanged at 28.15. High's been 27.95. the low has been 27.95, the high 28.54. Stock market futures, the indices are virtually unchanged, so I won't go through them. And so are the currencies, actually, the fiat currencies. Crude oil as well is unchanged overnight. So very quiet here. High-grade copper is up a bit, 0.5% at 468. And yeah, that's where we're going to end today. A little shorter than usual, but why not? I'm going to wish you all a very good start to this week. And yes, and I'll talk to you later. Take care. Bye.